Welcome back to Gold Rush Reporter, your home for sharp, no-nonsense analysis on the gold and silver markets. Today, we're diving into a question that has the entire silver community on edge. Will everything come to a breaking point in March 2026? Some analysts say yes, others say the pressure has been building for years. But instead of blindly following hype, let's break down the facts, challenge the assumptions, and look at what's really driving the tension in the silver market. Before we move forward, hit the like button if you want more blunt, bias-free analysis. And drop in the comments whether you think March 2026 is the real tipping point or just another overhyped date. Now let's get into the truth. 2025 has already been one of the most dramatic years for silver. Record demand, tight inventories, strange market glitches, and rising industrial consumption have pushed silver into the spotlight. And the year isn't even over yet. But what's really making analysts nervous is what's ahead, not what's behind. Many believe the entire derivative structure around silver, especially in the Comex and LBMA, is becoming dangerously unstable. Some think it's heading toward collapse. Others think it will be forced into a complete restructuring. And whatever happens, they argue it must happen before April 1st, 2026. Why that date? Because that's when the Reserve Bank of India's new policy kicks in, allowing banks to accept silver as collateral for loans. That's a major shift for a country that consumes more silver per capita than any other nation. Some people are jumping to conclusions, claiming this means silver is being remonetized in India. But that's not true. Silver isn't becoming currency. It's simply being recognized as a significant asset that banks are willing to trust. Given India's massive population and cultural demand for silver, this policy still holds huge implications. Now combine that with the cracks showing in the global derivatives market. The Comex, the LBMA, the large bullion banks, all of them are operating in a system built on layers of paper claims. And according to several analysts, including the well-known online poster Hansa Kearney, we're reaching a point where the amount of paper silver massively outweighs real physical metal. He argues that this isn't speculation, it's basic physics. And honestly, he's not wrong about the fundamental math. Too many claims, not enough metal. That equation never ends well. But the mistake many people make is assuming every glitch or outage automatically means a conspiracy or planned manipulation. That's the emotional trap the silver community falls into far too often. Yes, there is corruption. Yes, the system is flawed. But not every hiccup is part of a master plan. The truth is more boring and more dangerous. The system is simply stretched too thin. If we want to understand whether March 2026 is truly a breaking point, we need to look at the stress inside the system instead of the noise surrounding it. The silver market's biggest weakness has always been the same. Too much paper, too little metal. Every year the ratio gets worse. The amount of physical silver available is shrinking due to mining constraints and massive industrial demand, while the amount of paper silver being traded grows like a monster with no brakes. This imbalance is the core reason analysts think the system is approaching a limit. Mining companies have been warning for years that silver supply is tightening. New discoveries are rare, and most mines are producing less than expected. At the same time, industries like solar, EVs, medical tech, and electronics are consuming more silver than ever. These industries don't care about spot price. They care about securing supply. When industrial demand rises and investors begin buying physical at the same time, the paper market loses its ability to control the narrative. That's the pressure point analysts are focusing on. Then there's the derivatives structure. Comex has built a reputation for allowing an absurd amount of silver to be traded on paper with very little metal backing it. In normal times, this works because most traders never ask for delivery. But what happens when delivery requests rise? Suddenly, the system looks fragile. The problem isn't that it's corrupt. The problem is that it depends on everyone playing along. If too many people request physical metal, or too many institutions start moving in at once, the structure gets stressed fast. This is where Hansa Czerny's arguments start to make sense. He believes the system is entering what he calls a hard physics limit, meaning no amount of manipulation, policy change, or market action can fix the mismatch between real metal and paper claims. You can hide financial problems, but you can't create physical silver out of thin air. When supply dries up, everything stops. But there's still a major flaw in the assumptions many people make. They think glitches or outages must be deliberate. They assume every error means collapse is starting. That's not how complex systems fail. Most of the time, the early signs look random and unplanned. A few trading issues here, some weird price moves there. Nothing dramatic enough to panic the public. But under the surface, the pressure keeps building until one day the system simply can't absorb any more strain. This is why analysts point to early 2026, not because it's guaranteed to be the end, but because all the pressure lines intersect around that time frame. Demand, supply, derivatives exposure, industrial expansion. Everything is converging. And if the system is going to break or reset, that window makes the most sense. If a breakdown happens in the silver market, it won't look like the dramatic crash people imagine. It will look like hesitation, delays, and silence from institutions that normally operate smoothly. The first sign is usually not a price spike. It's the inability to deliver metal at the posted price. When the system becomes stressed, wholesalers stop offering large orders. Dealers raise premiums quietly. Industrial buyers sign long-term contracts at higher prices just to protect themselves. All of this can happen without a single headline, and by the time the public notices, the shift is already well underway. Another factor almost nobody talks about is the behavior of big players during stress. Banks and governments hate sudden change. They'll do everything possible to slow it down, smooth it out, or distract people from what's happening. But the mathematics of supply and demand eventually wins. If the world keeps using more silver than it produces, price suppression becomes harder and harder to justify. The only way to maintain the illusion is to expand the paper market even more. And that's exactly the trap Comex is in. Central banks add another layer to this problem. Gold has already been recognized globally as a reserve asset again, but silver hasn't. That creates a strange gap, where one monetary metal is being accumulated aggressively while the other is being ignored publicly but drained physically behind the scenes. Investors think silver is irrelevant because central banks don't hold it, but industries think silver is essential because nothing can replace it. This imbalance is what turns a normal shortage into a systemic event. Now let's be blunt. A lot of people online exaggerate the timeline. They talk like silver must explode any day now. That's not how markets work. A system this large doesn't fail from emotion. It fails from numbers. And the numbers are telling us something uncomfortable. Silver deficits are accelerating, industrial demand is rising aggressively, and trust in paper markets is eroding. That combination doesn't point to a smooth transition. It points to a trigger event that forces a repricing. But here's the catch. Even if the paper market breaks, investors won't magically become rich. The price won't instantly reflect real scarcity because the entire financial structure built around silver will be under stress. Liquidity dries up. Bid-ask spreads widen. And the very people expecting a windfall might struggle to sell at the new inflated price. Markets don't reward people just because they were early. they reward people who understand timing and exit strategy. This is the uncomfortable truth most silver influencers never mention. A reset doesn't guarantee profit. It guarantees volatility, confusion, and a complete rewrite of how silver is valued. And if early 2026 brings even a partial breakdown, nobody gets to sit back and relax. Everyone will have to adapt quickly. As we move deeper into this situation, the tension inside the global silver pipeline becomes harder to ignore. The cracks are no longer theoretical. They're visible, measurable, and getting worse. And the biggest pressure point right now is the imbalance between physical demand in Asia and the paper-driven system in the West that keeps pretending supply is unlimited. China has already shown the world how aggressively it is willing to drain physical silver when prices disconnect from reality. Shanghai's vault inventories collapsing to around 39 million ounces is not a normal fluctuation. It's a clear signal that physical metal is being vacuumed up faster than it can be replaced. When Asia is hungry, the West doesn't get to choose whether silver leaves the vaults. It just leaves. That's not a theory. That's how global arbitrage works. India is doing the same thing, but for different reasons. Industrial demand, investor demand, cultural demand. It all stacks on top of each other. And when Indian buyers step in at the same time as China, there isn't a single Western market that can refill London fast enough. London's physical pool was already thin. Now it's flat out vulnerable. And the more people pretend there's plenty of metal available, the more obvious it becomes that they're ignoring the math. Add to that the fact that the New York market isn't rushing to bail out London either. Why would it? US demand is rising, and the price structure offers no incentive to ship metal across the Atlantic. No one sacrifices their own physical liquidity just to protect someone else's paper stability. That's not how markets behave. Meanwhile, the stress signals continue to flash across the Comex. Halts, outages, unexplained anomalies, weird prints. None of that is normal, and pretending it's just technical noise is lazy thinking. These issues always cluster around moments of pressure. That's not random. Even if none of these stress events point to a coordinated manipulation, they still expose a system stretched far beyond its design limits. Comex is not built to deliver 594 million ounces of silver in a single month. It never was. Yet that is exactly the level of open interest converging on March 2026. If even a tiny percentage of that paper tries to convert into physical, it triggers real strain. 5% alone means 30 million ounces, more than enough to test weakened inventories. And the historical upper limit of extreme stress, 8 to 10%, would be catastrophic. The numbers don't lie. The system can roll paper forever, but it can't roll physical. And when physical becomes the constraint, the entire game changes because reality finally overrides financial engineering. This slow migration of stress from London to Comex isn't a rumor. It's a pattern. And patterns matter, especially when they repeat at moments when demand for physical silver is rising globally. The clock is ticking toward the first quarter of 2026, whether people like it or not. All of this brings us to the real question. What actually happens if March 2026 pushes the paper system to its limit? The uncomfortable truth is that no one can give you a guaranteed outcome, and anyone pretending otherwise is selling you fantasies. But we can map the possible scenarios, and none of them look harmless. If delivery demand stays in the normal 1 to 3% range, the system will likely survive, but it will still expose how fragile the current setup has become. If the stress zone hits 4 to 6%, the cracks become impossible to hide. Inventories tighten aggressively, premiums rise, and liquidity weakens. Above that, the situation becomes dangerous. 8 to 10% is where the structure bends. 12 to 15% is where it snaps and forces immediate intervention. That intervention could come in many forms, and none of them favor the small investor. A rule change, cash settlement, forced rollover, delivery denial, all of these have happened in other commodity markets, and there's no reason silver would be exempt. History shows that when the system is at risk, regulators protect the system, not the holder. And that's exactly why physical silver matters. Physical doesn't wait for permission. It doesn't depend on the solvency of a clearinghouse. It doesn't freeze when an exchange glitches. It doesn't disappear behind opaque accounting. It's real, final, and outside the paper ecosystem. That single characteristic is the reason physical is becoming the true benchmark again. As the market shifts from paper price discovery to physical price recognition, volatility will increase and price behavior will get more violent. But violent does not mean unhealthy. It means the system is being forced to reflect conditions it has ignored for decades. The silver market has operated on a distorted foundation for far too long, a foundation where hundreds of claims sit on top of a single ounce. That structure only survives when no one asks for the ounce. Once they ask, the illusion ends. And whether March 2026 becomes the breaking point, or just another escalation point, the direction of the system is already set. More demand for real metal, less trust in paper, more pressure on inventories, less patience for excuses. The smartest approach right now is to stay grounded, think critically, avoid extremes, and protect your position with physical ownership. Not hype, not dreams, just reality. That's the whole point of talking about this at all. Thank you for watching Gold Rush Reporter. If you found this breakdown useful, make sure to rate, share, comment, and subscribe. Stay sharp, stay informed, and keep stacking with purpose.